Good afternoon, everyone, and welcome to Next and My Next Raise March Partner Webinar with Aranka, all about 409A valuations, what they are, why you need them, the importance of them. My name is Lisa Friedlander. I'm the CRO of Next, powered by Shulman Rogers, as well as My Next Raise. Together, Next and My Next Raise offer an innovative and award-winning legal and fundraising solution for early stage startups. We produce these partner webinars with our valued partner service community that provide all different types of valuable products and services to startup and emerging growth companies. I'm really grateful that our partner Aranka has joined us for today's webinar on understanding 409A valuations. We will discuss 409A valuations and their critical role in managing stock compensation for businesses. We will cover the taxation of stock compensation in the U.S., the definition and importance of a 409A valuation, penalties for noncompliance, why an independent appraisal is essential. We'll address whether U.S. companies issuing options to foreign nationals should obtain a 409A, and lots of other super important topics. We're excited to be able to welcome Jitendra Pabakar, who is the CFA, the Director of Aranka's Valuation and Financial Advisory Practice. So just in a minute, I'm going to turn it over to Jitendra. But before that, please feel free to put questions in the chat. We will reserve time at the end after the presentation. But if you're concerned about forgetting your question, as sometimes that happens to me, feel free to put your questions in the chat and we will address them at the end of the presentation. Without further ado, I will turn it over to Jitendra. Thank you so much for being here.
Thanks, Lisa. My pleasure. And thanks for hosting this webinar. It's my pleasure to talk to you, lovely people, and share whatever little I have gathered so far. I have been practicing business valuation for the last 19 years. I have been employed with Aranka since then. And Aranka as a whole has almost 2 decades of experience working on valuation domain in USA. So I'm going to start here right now. So just to give background agenda for the presentation. So initially I will talk briefly about history about 409A, how it came into existence, and then how it affects the startups and what are the precautions startups should take while issuing stock options, complying with 409A, what are the penalties, and then I'll touch upon some valuation issues as well as what are the different type of options typically issued by startups to uh, the employees. So start with so IRC 409A came into existence towards end of 2004. So how was the life before that? So I will shed some light on that before talking more about 409A. So IRC 409A relates to deferred compensation, and before 2004, there are a lot of Liberty corporate executives had to design their own deferred compensation in a way to delay the tax payments, and it was happening fine. But around 2002, the corporate USA was stuck with a lot of scandals and naming. I'm sorry, my presentation is not up. Lisa, please tell me if you can see my presentation.
Yep, I was just about to interrupt you. I wasn't sure if you were giving an intro and then was going to share. But yes, we cannot see your presentation quite yet.
Sure. Okay. So I was at in 2002, corporate USA was stuck with a lot of scandals like
One second, Chandra, were you going to share that we can't see your presentation?
Yeah, it's coming now.
Now?
It's coming now.
Yeah.
Yes, go ahead and put it in presentation mode and we should be good to go.
My apologies for that.
No problem.
Okay.
Perfect.
There we go. Thank you so much.
My pleasure. Okay, so how life was before 2004, corporates had a lot of liberty to structure deferred compensation of their employees, which was kind of changed after 2004. So, what was the catalyst for this change? What happened around 2000 is corporate USA was struck with a lot of corporate scandals where their financial records were window dressed to show a prettier picture about their performance, which actually was not the case. Many of them actually went bankrupt after some time. So, what happened because of these corporate scandals? The Congress took a serious note about how executives are using the leeway available in financial reporting as well as their compensation to benefit from it. One way to inflate the earnings or the financial position of the company. On other hand, structuring the deferred compensation in a way they can time their tax payments. That's one way of kind of enriching themselves. So what happened in 2004? This U.S. Congress came up with a act, which is American, Job Creation Act 2024. Under this act, this IR Section 409A was inserted into uh, Internal Revenue Code, and thereafter, the deferred compensation was closely watched by IRS for its structuring and potential to delay the tax payments. So, though these corporate events or the scandals which took place, which kind of led to enactment of this section in IRC, were not exactly related closely to stock options, but it definitely increased the scrutiny into the corporate affairs. And one of the areas that Congress focused on was the deferred compensation. And under IRC 409A, there are limits put on the deferred compensation, how it should be structured, and it reduced, curtailed flexibility to a greater extent. So after 409A enactment, if any corporate has to give any deferred compensation to its employees or executives, they have to be timed. On the onset, the time has to be certain. Even the payout has to be certain. Unfortunately, in case of stock options, that's not possible because the upside can be, anything when actually the stock is exercised. So that's why stock option doesn't remain as a good tool as a deferred compensation after 409A. And that is the reason uh, corporates have to ensure that they do not use option as a tool for deferred compensation. And to comply with that, they have to ensure that they issue their options with an excess price, which is not less than the fair market value of the underlying common stock. Because if a common stock is issued with a strike price below fair market value, there is an immediate transfer of value to the employee because they are getting stock cheap, and that might be for the service that they have rendered to the company, but actual tax payment on this gain is going to happen when they exercise the option. So that is one way to delay the tax payments, and that is what IRS wants to avoid, ability to shift the tax from the present to someday in future. So that's why corporates are compelled to issue stock options at the fair market value of the common stock. So every corporate which is issuing stock options, especially the early stage companies which compensate their employees more in terms of equity plans than the cash incentives. Uh, so they issue options to their employees more frequently, and every time they issue stock options, they need to know what is the fair market value of the underlying, that is common stock. And since these are private companies, they do not know what is the worth of their common stock. That's why they have to do the assessment of fair market value of the stock, which can be done internally or they can hire third party. The regulation doesn't state that one has to have a third party to do the assessment, but obviously there are some pitfalls that one should be aware of while one using that option. So these valuations are done very close to the stock option issuance. So ideally, it should be on the same day when options are being issued, and because the worth on that same day needs to be compared to the strike price. But it's not practical to have the valuation on the same day because company might be issuing multiple rounds of grants. So it is advisable to do the valuation, get the valuation more frequently and keep it close to the option date as much as possible. You may not have the report on every option grant, but at least there you can keep the option grant clustered around the valuation report that you have, or you can do all the grants together once in a year where actually you have proper backing for those grants with a properly made 4098 report from independent appraiser. So typically people assume that once they get a valuation report, it is valid for 12 months and they can issue options based on this report for 12 months. Again, it is not stated in the statute, so one cannot use that for kind of a own relief. Uh, the statute says that you need to know what is the fair market value of the underlying on the grant date. Okay, so old reports may not work. Sometimes people do use reports for 12 months. It's a longer period. Uh, and especially when company is growing at a faster pace, the valuation report becomes obsolete very fast, right? So if company achieves new milestones, go for a funding, raise fresh funding, there is some change in the product, they enter new market, all these things are happening at a very fast pace. So older report, it is less useful for you. So that's why one has to get the valuation report very close to the grant date. And if it is an old report, then it will be advisable to be sure that there is no any event between the report date and the grant date which has potential to change the company's valuation. Because unless you tick all these boxes, right, you may not be able to get benefit of safe harbor. That will I will speak about in the following section. So though, as I mentioned, company can do the internal assessment about the common stock fair market value, but it is advisable to hire third party appraiser who is qualified as well as has done more of such work to be confident about the output, about the defensibility of the opinion. So all these things are offered by the qualified appraiser, but this is not the best benefit of hiring third party appraiser, but the best benefit is of getting benefit of safe harbor that you can avail if you are getting valuation from third party appraiser. So what is this safe harbor that I'm talking about? So IRAS gives relief to the companies which base their option grants, they decide their strike price of option grant based on the third party assessment. So how it helps the company is that it shifts burden of proving that you issued stock at a cheaper rate on IRS rather than the company having to prove that they issued options at a right excess price, which is at fair market value. Okay. And for companies like early startups, this relief becomes very important because valuing early stage startups is more of art than science, right? So even if you do all the mathematics right, there still will be a lot of scope for scrutiny or criticism, right? So if you want to save yourself from the scrutiny of IRS, which can pull up your report because it's internally prepared, you can hire a third party and transfer the burden of proving that you have issued cheap options on IRS. And again, given the size of the company, size of the grant, the tax dollars at the stake, IRS may never pick up your report if they do not see any potential misconduct in that. However, if you do not get a third party valuation report, since burden is on you, okay, and if you've done everything right, and even after long battle with IRS, if you prove that you have not issued options at a cheaper rate, but you have done the right thing, but still then you have lost a lot of time of your senior executives, and also spend a lot of money on this battle, right? So if you want to save that much time and money, it's advisable to do the right thing at the right time, getting the appraisal report from third party. So that's about how you comply with 409A, and what are the kind of benefits of hiring a third party appraiser for the valuation. But what happens if you do not comply with IRC 409A, right? If somehow IRS proves that you have issued stock options at a cheaper exercise price, so there's a big cost for the employees, if not for the employer. The employees pay the normal tax rate that they are liable for on the deferred compensation, which is nothing but difference between what IRS approve as a fair market value on the grant date and the excess price of the option. For example, I have put this example on the screen where the option grants were done at 50 cents, but actually, it was proven that the fair market value on the date of grant was $2, right? So because of that difference and the number of options, in this case, the total income that employee immediately benefited from is $750,000. So that becomes income in the hand of the grantee, and that becomes immediately taxable at the whatever marginal rate that employee is liable for. On top of that, there might be 20% penalty on this difference, and plus premium and even interest can be charged if it is this is proven after some time. So whatever the time lapsed after the default, IRS might pursue this case with a requirement for penalty as well. So this consequences are severe for employees, and for early stage businesses, they are the most valuable assets, and upsetting the employees will never benefit the company. So to be cautious and be careful about how you can save your employees from the pain that they might go through if IRS proves that the cheap options were issued. It's advisable that you make avail of the safe harbor and get a defensible 409 valuation report from third party. So that was about the penalties. Then I would like to talk about what are the different type of options typically start as issue. So there are two type of options. First one is the incentive stock option, and another one is non-qualified stock option. As the name suggests, in first case, these shares are issued kind of as accepted as an incentive to employees and are issuable to employees only. So these options cannot be issued to anybody apart from employees. And these grants come along with some tax benefits that I will talk about in the following section. But those tax benefits are not without any restrictions. These options are how much options can be issued to a single employee. There's a limit of 100,000 dollars. Okay. So in a 1 year, one employee cannot get vesting of option which are their underlying is more than 100,000. So that's the limitations comes along with these options. But if you structure these options well, the employees can benefit from tax treatment, which is they don't have to pay tax on the exercise. But at the same time, there is another restriction on this share, this kind of options issued to employees. If employee leaves the employment, these options need to be exercised within 3 months after they leave the employment. So of course, there are some exceptions like death and disability, but otherwise there is a 3 months limitation on of exercise of the options. On the other hand, the non-qualified stock options can be issued to anybody, including employees. So, but this can be advisors or anybody outside company as well. And there are not such limitations on how many options can be issued to anybody. So this kind of grant is limitless. At the same time, how long one can exercise these options after termination, there's no cap on that as well. Every plan can have a different kind of provisions. If the options are NSOs, non-qualified stock options. Talking more about tax benefit of issuing incentive stock options compared to NSOs is, as you see on the screen, on the exercise date. If options are issued under ISO scheme, no tax becomes payable on that day. But this grant, excess might trigger minimum alternate tax. Again, you get credit for that when actual tax liability is assessed. But you get exemption from paying any tax here apart from the MAT. On the selling of share, you will be liable for paying capital gain tax on whatever gain you have made beyond the exercise price. On the other hand, when you exercise NSOs, there's immediate tax liability that is created at at amount which is different but fair market value of the stock on the exercise date and what is the exercise price. So the grantee has to pay tax at his individual marginal tax rate on this difference. And beyond that, when he actually sells the share, again there will be capital gain tax applied there. But in this case, you get benefit of paying tax on the on the exercise because your basis is adjusted to the exercise fair market value on the excess price from your excess price itself. So there will be some relief in that when you pay the capital gain tax. But to save that much capital gain tax, you have already made payment of incremental income tax, which is typically on a higher rate, higher side compared to capital gain tax. So there is a definitely benefit, getting grants in ISOs than NSOs. So after this, I will touch upon typical valuation issues that we encounter because usually these option grants happen around a period of fundraising, and founders have recently raised money, have spoke about valuation with investors, and then after that, or maybe as a part of deal, they have agreed on some kind of option grants to senior executives. Okay, so they are coming out of a discussion on a valuation for fundraising, and now they're talking about a valuation for option grants. So how these two valuations are different? So I would like to shed light on the differences of these two valuations. So typically, when a company raises money, the valuation that is agreed with the investors, it's called post money valuation, and it is calculated on the basis of the price in that particular round. For example, if company raises preferred share at $5 per piece of preferred share, which is newly issued, under post-money valuation, it is assumed that every single share in the cap table has the same value. So simply multiplying that $5 to all the shares in the cap table will give you the post-money value. Again, the assumptions here is that every single share has a similar worth, and that's the premise on which this calculation is done. However, when appraiser does valuation for 409A compliance purpose, okay, here the difference in economic and non-economic rights of preferred and common is rightly captured in the calculations. So that's why appraiser would not treat common share value at par with preferred, because preferred has liquidation preference, sometimes participation rights, and beyond it all they also have kind of sometimes board seat or at least right to oversee the operation of boards. But the single common share or the employee common share with the employee do not have all these economic as well as non-economic rights. So obviously one cannot value common share at par with preferred. So this is rightly captured in the analysis which is performed for 409 evaluation. That's why if you compare these two valuations, the post-money valuation would always be on a higher side compared to one, the 40 valuation that company gets. Because obviously, in one case, the assumption is that all the shares are as valuable as the preferred series that company raised. But the other approach is treating shares based on their relative preferences and rights. So that's why, when we do for the evaluation, this is something that, usually founders talk about, and then when they compare report issued by appraiser, they compare to the valuation that they saw in the funding round, and sometimes they fail to kind of bridge the gap between these two. That's why I thought it will be beneficial to talk about this issue. uh, so this is the last slide that I have, but I would also like to talk about another issue that typically pesters founders uh, when it comes to option issuance and fundraising, which is sale in secondary shares. So what we have seen our our experience typically with the companies which are at a mature stage, where the need for capital in the business has kind of gone down because they are consolidating, focusing more on improving the bottom line than just growth. So they typically raise more money and use that excess money to buy back shares from founders or other employees to give them kind of partial exit. This is the one kind of secondary transaction where you know uh, the shares, sometimes company buys the shares, or they facilitate selling of common shares to the same investors who are bringing in preferred capital in the business. And typically this happens at the same price, the price at which preferred has been sold. Even common is given same price in the same transaction. Okay. So why I'm bringing this to, kind of a for discussion is, this is the typical mistake that, we have seen in our experience that, startups do in fundraising. They allow common stock being sold at a price of preferred. So what happens because of that? Even if you are engaging a third party appraiser, okay, he finds it very difficult to refute that common stock is not as valuable as a preferred, because there is a evidence that somebody has paid same price for common. Okay, so no matter how much theoretical debate you might do to kind of defend your stance that common should be valued less than preferred, but if there's a transaction which has happened recently, it's very difficult to ignore that. So we have to assign some weight to that, or sometimes actually give an opinion that common is actually can command as high as preferred stocks price in the recent round. So that hurts the interest of employees, because if you compare two securities, actually they are not at par, but just because one transaction in secondary, you have to opine that the common is valued highly, and accordingly, if you grant options in the same period, the excess price that company has to decide is going to be on a higher side. So that way, employees will have to pay a higher amount for their common shares. So this is the typical mistake we recommend our clients to avoid when there is any secondary transaction. Even if in absence of any funding round, if there is secondary transaction, it is always beneficial for the company to be part of that and structure that transaction in a way that that doesn't become a benchmark for your 4009 evaluation, because it will end up hurting your employees. They will have to pay more for their common stocks. So that is all from my side, and I would be happy to take any questions that you might have, and talk more in detail about those areas which are more of your interest. So please go ahead and put your questions in the chat box, and we'll respond to those questions one by one.
Thank you so much, Jitendra. It's so much information, and really appreciate the way that you laid it out in a super simplistic way, but lots to dig in here. So folks, feel free to unmute yourself, raise your hand, put questions in the chat, whatever, or you feel most comfortable with. One question, that we get a lot is sort of when do we need to do this? I know you covered it a little bit. But talk about sort of when you advise companies to get this done. And then we also have a question from Maren in the chat. How iterative are post-money valuations with the company leadership? Was her question.
Okay, I got a first question. What was second? Can you say that again, Lisa, please?
My question in terms of timing, like when should founders start thinking about this? And when should they actually get one?
Sure, sure. So I will respond to first question, then maybe we'll come to the second one. So as I mentioned, the valuation report that you get for 409A has to be close to the grant date. Ideally, you should have the fair market value of the common stock on the grant date itself, but it may not be practical. So that's why you aim to keep the valuation date of for 409A close to the option grants. That is advisable. So how often you should get the valuation? So ideally, again, it should be done on every grant, but again, it might be costly to do the appraisal. So companies can kind of do all the grants somewhere in the same area where you have a well drafted defensible report to support all those grants. Or if that's not possible, okay, so at least be sure that your report is not so old that one can say that that doesn't will not stand scrutiny of IRS to be a kind of a benchmark for the option grant that you have made. How to do that is, ensure that there is no material event between the option grant date and the report date. Okay.
Okay.
So as long as there is no material event like company raising money, fresh funding, or kind of any major change in the management, entry in a new market, launch of a new product, all these events will raise a question: why do you believe the same valuation stands true after all these events, right? So one cannot be sure of that unless you do the assessment, right? So that's
Mhm.
why you need to get the valuation done again, but there are no such events in between. So I think 6 to 8 months kind of, again, I cannot guarantee. It depends on who is asking the question. If somebody wants to kind of scrutinize more rigorously, he would ask for something which is just 1 month old maybe.
Mhm.
But I've seen people take a report once in a year and try to kind of cluster their option grants around the same date.
Got it. Great.
uh,
Thank you.
so
And then the
I
second
would appreciate.
question
Yeah.
is how iterative are post-money valuations with the company leadership? And so Maren, do you want to pop on and explain your question a little bit more?
Sure. I was just wondering, if you get an independent assessment, first of all, like, who does that? Does the company initiate that with a third party, or do the investors initiate that? I assume if the investors do, then, the company's just subject to whatever they determine. But if the company initiates it and sort of provides it to investors, is that something a third party would, develop a sort of hypothesized answer, and then you can kind of go back and forth with them
Yeah, for a post-money,
more about the mechanics of how it gets implemented.
Yeah, when you're valuing the company as a whole, not a 409A.
Yes, sorry.
Yes. Well, I'll respond first, and then Jitendra chime in just from a next law. I mean, we do this all the time. Depending upon, the stage of the company, the size of the company, and all that, typically for early stage companies, the post-money valuation is more of a conversation. It is a art, not a science. It's typically sort of, the founder's best sense of where they are and finding an investor or speaking with investors that agree based upon, comparables in the market and the industry, again, where they are, how far they are. So it's more of a, we think we're this. Okay. And if investors agree with, you may go back and forth a little bit. It may be a little bit of a negotiation. It's certainly with a safe or a convertible note, price rounds are a little bit different. But in the earlier stages, it's more of, what
it's
feels
a company
right,
assertion, basically.
And what feels right to both parties. Yeah.
Okay. And so Next works with your clients to help.
Yes.
Okay. Got it.
We have a fixed fee fundraising package for our clients. So it's a fixed fee. It's $850 a month for a year. And we work on everything from soup to nuts with you, including the strategy discussions and business discussions around valuation.
Okay.
Jitendra, anything to add to that?
Lisa, you rightly said valuing early stage companies more of a art than science.
Yeah.
But what I typically we recommend to clients, so look at what valuations deals are happening in the market in the similar space,
Mhm.
and how you stand a better chance of being at a higher side of that range, right? So, and that when you make a pitch, the pitch deck, or when you present the information to the investor, right? Transparency, clarity about your business plan, having backups after backups, if one thing doesn't work, what's your plan to, kind of tackle those issues. So more clarity you present to the investors, you have, better chance of ending on a higher side of the range. But again, obviously, at the early stage, investors always come with an expectations which are coming from the market. They have already saw the valuation at which deals are happening in that space, and that will be starting point. In a later stage, when actually you have proven and there's clear differentiation between your company and others, you can make a better case based on the facts. But in early stage, I believe that's how investors look at this valuation. Uh, Again, coming back to our presentation where we are comparing the post-money valuation to IRC valuation. So definitely you can engage third party to prepare you well and understand in which range the valuation is ending for similar businesses. That might be good for you in terms of having a conversation with investors, in a methodical, more intellectual manner, because you know where the market is, right? So that is definitely. But obviously, this is not the value that appraiser gives, but actually it is a value calculated from the price at which investors have agreed to invest in the company. Okay, so when I say post money, it's a kind of a post facto. Deal has already happened, and then based on that, you're calculating, what was the post money in that valuation in that particular transaction.
Awesome. And thank you, Tejas, for putting in your emails too. I'm going to add our our landing page for folks. If you wanted to go ahead and learn more from Aranka, you can complete the contact form. And then obviously the emails is there. We will also be circulating a recording of this session, and Jitendra and Tejas from Aranka will be copied so you can reach out to them directly. Other questions? We still have some time left in our session if folks have more questions. Last call, are you sure? Going once. Well, we can certainly give folks a little bit of time back in their day if there are no further questions. Again, you can reach out directly to Aranka via email or via completing the contact form on the landing page. There's more information about Aranka and 409As on the MyNextRaise platform. The link was in the chat above. It's mynextraise.com. All of our resources are free. All of these events are free, but we do also have a suite of investor readiness tools for a premium membership that is now on a discounted launch price. So definitely take advantage of that by going to mynextraise.com. I want to thank Aranka, Jitendra, and Tejas for being with us today. We're really grateful for your partnership. Appreciate you participating in the MyNextRaise platform as a trusted partner, offering this webinar today. I'm sure we'll be offering more, as this is such an important topic that many founders just don't know about. It's so you don't know what you don't know moment sometimes until it's too late. So thank you all. Look forward from an email from me, again, connecting you with Aranka as well as the recording of today's webinar. So thank you all so much and have a great rest of your day.
You too. Yeah.
Thank you, Lisa.
Thank you. Thank you. Bye-bye.